Hello and welcome back to another video. Today we're going to be looking at certificate of deposits. Now in this video I'm going to fully explain exactly what they are, how they work, as well as all the benefits and disadvantages. So make sure you watch this all the way to the end so you don't miss any important details. So to start with, what is it? A certificate of deposit, also known as CD, is a type of savings account that offers a fixed interest rate for a fixed period of time. This means that you know exactly how much interest you will earn on your CD regardless of what happens to market interest rates. CDs are a popular way for people to save money because they are considered to be safe and secure investments. Your money is insured by the FDIC, which is the Federal Deposit Insurance Corporation, which means that your principal is guaranteed up to $250,000 per depositor per insured institution. CDs are also insured by the NCUA, which is the National Credit Union Administration, for up to $250,000 per depositor per insured institution. So how exactly do they work? To start with, you open a CD. You can open a CD at most banks and credit unions. You will need to deposit a large sum of money into the account and choose a term length. You will also need to provide the bank with your personal information such as your name, address and social security number. From there, interest is earned. The bank will pay you interest on your deposit for the term of the CD. The interest rate is typically fixed, so you will know exactly how much interest you will earn. Next up, there's a maturity date. The CD matures on a specific date, typically ranging from a few months to several years. At the maturity date, you can choose to withdraw your money, renew the CD for another term, or roll it over into a new CD. And finally, it's important to know about early withdrawal, because if you withdraw your money from a CD before the maturity date, you may be subject to an early withdrawal penalty. The penalty will depend on the terms of your CD and the amount of time you have left until the maturity date. So what are the benefits? To start with, there's a fixed interest rate. CDs offer fixed interest rates, which means that you'll know exactly how much interest you will earn on your deposit, and this can be helpful for planning your finances. There's also guaranteed returns. CDs are insured by the FDIC or NCUA, so your money is guaranteed up to $250,000 per depositor per insured institution. And finally, there's compounding. Interest earned on a CD is typically compounded, which means that you'll earn interest on your interest. And this can help you grow your money more quickly. So what about the disadvantages? To start with, there's limited liquidity. CDs cannot be withdrawn without penalty before the maturity date, and this means that you may not be able to access your money if you need it urgently. There's also interest rate risk. If interest rates rise after you open a CD, you'll be locked into a lower interest rate for the term of the CD. This means that you will earn less interest on your money than you could have had if you had invested it in a more liquid account, such as a savings account or a money market account. And finally, there's limited investment options. CDs typically offer lower interest rates than other types of investments such as stocks or bonds. This means that your money will grow more slowly in a CD than it would in a more risky investment. So this has been my video explaining what certificate of deposits are, how they work, as well as all the benefits and disadvantages. Hopefully now that you've watched this video, you understand everything you need to know about certificate of deposits, and you can use some of the knowledge you learned in this video to help you invest in the future. If you found this video helpful, please go ahead and comment down below to say it helped you out, and like and subscribe for more content like this. Thanks for watching.